It's bad. I'm your host, Steve Metre, and thanks for joining me today. In our show today, it's a shocking report nobody saw coming that indicates that the U.S. economy is at risk. I'm going to show you the market's reaction to this report. Then I want to do a quick review of what's going on with the Japan carry trade. And then we're going to get into this report, and you're going to find out that underneath the covers from the headline, the U.S. economy is in far worse shape than the experts believe. Plus, we have a sponsor of today's show. I'd like to welcome Above Food back to the show. You can find them on the NASDAQ under symbol ABVE, and they're a regenerative ingredient company. And the reason you want to check them out, because if you are a trader, I'm going to show you an incredible chart setup because their stock is trading in right in between two zones right now, and it's at the lower zone, setting up a move, as you'll see, for a 24% potential return. Again, on the NASDAQ under symbol ABVE. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where he picked today's story up with a headline: as stocks climb as jobs data quell economic jitters. And that is the whole story of the equity markets right now, that the market is afraid that it missed the calling, that we're heading into a recession after it saw the non-farm payroll report. But right now, everything is focused about the labor market. And I'm going to show you a report here in a little bit that indicates that the U.S. economy, particularly the labor market, is not as strong as the headlines indicate. And some good news this morning with jobless claims coming in less than expected. It's hard to believe a recession has already begun. And that's really the issue here when we talk about the stock market, because the stock market always gets it wrong. It's always the last one to figure out we're in a recession. I'll give you some more evidence on that, but let's continue as we're exercising caution. But I think that the panic that started earlier in the month was overblown. And this is exactly the reaction investors had. They jumped in, they bought the dip. But there's something wrong with the markets here because it's not rallying as it used to. And this has everything to do with that carry trade in Japan. We'll give you some more information on that. But let's first take a look at this chart from Above Food. Again, on the NASDAQ, on the symbol ABVE, you can see it trades between these two zones here. We'll look at this chart in more detail at the end of the show. You see it trades down. It rallies up for about 24% return. It pulls back, and here it is in that lower zone, looking to make that next setup. Again, stay tuned to the end of the show, because when we talk about the equity markets being on the wrong side of the trade, all we have to do is look at two-year treasury yields, because you can see that it's really the bond market that gets the recession call right. It's the stock market that gets it wrong. And you see pullbacks like we did, and all this does is pull money into the market because everyone believes that stocks suddenly are on sale and they need to buy the dip, because we're really in a bull market, not in the beginning stages of a bear market. But the bond market here disagrees completely. And so we look at this chart here, you see two-year treasury yields in red, and they really lead the market into a recession. You see that yields start to fall, and then eventually the official recession indicator shows up. You see it again in the global financial crisis. And look now, you see it starting to happen again. But what about the reaction from the market? It's, oh, there's a pullback, let's buy the dip. There's a pullback, let's buy the dip. Hey, there's another pullback, we need to buy the dip. And yet, what turns out is that economic data reports, like the ones that came out today, get covered up and dusted over and said, look, it's not that bad. But when we get into the underlying problems with the economy, particularly this one report that changes everything, you'll see the U.S. economy isn't as healthy as all the dip buyers think. And any data which suggests the Fed isn't behind the curve in regards to its likely rate cut in September is welcome news for investors. Now, keep in mind that investors believe, and they're being told by the Fed, that monetary policy works with long variable lags. That is when the Fed raises rates. But if the Fed cuts rate, it's meant to be instantaneous. And yet, if one works in one direction, well, then you have to believe it works the opposite way too. Because the main reason for the labor market here in terms of the focus will be on the next monthly jobs report. See, it's always on the next report. And until then, weekly jobless claims will likely warrant increased attention from investors. As jobs feed the consumer and consumption, this is a lifeblood of the U.S. economy. economy. So investors are hoping to see some stabilization in this area because they want to believe that the Fed's got this right, and that if the Fed just cuts rates maybe once or twice, that magically the power of the federal funds rate will reverberate through the economy and that everything will be okay. And yet we have note throughout history of central banking and policy rates, it doesn't work at all, but the market believes it. So the real question right now is, why isn't the equity market rallying and to new highs here? Well, it's everything to do with the carry trade. As JP Morgan now says, 3/4 of the global carry trade is unwound. And I said in a show the other day that all of this money flowing into the U.S. equity markets is really going to grease the unwind of these carry trades. And sure enough, it's doing exactly that. And it's one of the reasons we're not seeing the market rally back to near its former all-time highs, is because there are sellers underneath here because they've got to unwind these trades and fast. The recent sell-off has been double the usual pace in a carry drawdown, with strategists suggesting there may be small opportunity for a rebound in August, notably, which is the worst month for flows in the market to begin with, as the central bank calendar is light for this period and volatility already started to cool off, and again signaling what I said would happen, that hedge funds, after they bought in, would do everything they can to get out in the news and tell people to buy just in case it turns around so they can cash in on some quick gains. However, the global carry trade strategy is not offering an attractive risk reward. The yield on the basket has plummeted since the highs of 2023 and is not sufficient compensation for holding EM high betas through U.S. elections and the risk of further repricing of low yielders if U.S. yields fall. And so there's the issue. You want to know why the market isn't rallying right now? It's because all these people are borrowing in cheap currencies and buying on leverage, high risk, high return assets. Now they're out of those trades and they're not doing it, leaving the market here to kind of find its own footing. And what that means is we're not finding enough money to keep pushing it higher. So what you start to really find out here is the U.S. equity market isn't built on fundamentals. It's built on a massive amount of leverage, which is why when bubbles eventually burst, the stock prices come crashing down. And sure enough, we note that when the Fed does cut, it's usually not a good indicator, and it's always led by the market and not by the stock market, not by the labor market, not by inflation, but by two-year treasury yields. And we can see why there is a setup for September and why that carry trade is out the door and not coming back, even though U.S. investors now believe if you just buy the dip, you're going to get rewarded. But here you can see, of course, as two-year treasury yields fall, the Fed with a lag will eventually catches up to them, setting up right now as we look at two-year yields as the potential opportunity for a September cut. But there's one thing working against the bond market right now, and that's seasonality, because we know August and into September, it's usually the worst time of the year, at least in the past couple years. This has been effect of the stock market and the bond market, where we've seen yields actually go up. So if we do see two-year yields return to somewhere back where they were before, well, that's going to put the Fed on ice. But if yields continue to fall and the labor market's going to give them some reason to, we'll watch for the Fed to react in September, but not because of the stock market. So as we get into the reports now, U.S. initial jobless claims declined by the most in nearly a year as initial applications fell to 233,000. And I want you to see how the news validates what's going on in the market is buy the dip and look how great everything is. But really, it's not the headline that matters. And this isn't the other report. There's one more that says the U.S. consumer is indeed in danger. As the decline in initial applications may help reassure markets that the workforce is simply reverting to its pre-pandemic trend rather than rapidly deteriorating. And that was a consensus until last week when the jobs report showed employers substantially scaled back hiring in July and the unemployment rate rose for the fourth month, triggering a key recession indicator, or as we know, the SOM indicator. But that's not the big issue, because the SOM indicator, people that created it said, no, wait, it's not actually signaling recession this time, but the real concern here is that initial claims came down, and that is a change in trend. And this is what the market wants everyone to believe over one weekly report. Remember, it's not about one report, it's about the trend. And here we can see initial claims in blue against continued unemployment claims. And you can see that when initial claims start to cool off and decline, well, it signals that we're near term a peak in continued unemployment claims. And this is giving the market all the validation that perhaps that last payroll report was just one off, or maybe this is indeed the soft landing that the Fed actually started to accomplish, and that maybe that was exactly it, and that things are going to turn around from here. And so we continue to see in every instance that initial claims lag continued claims to the upside, but they do lead it to the downside, giving some investors at least a hope for the week to validate why they need to keep buying the dip. But the problem now is continued claims, a proxy for the number of people receiving unemployment benefits, edged up to 1.88 million this last week of July 27. And while initial and continuing applications for unemployment benefits have trended higher this year, and here's what the market's looking at, they're still hovering around 2019 levels, suggesting that, well, maybe everything's okay even if we see them go up. But one of the problems is yesterday we got a report that indicates the U.S. consumer is totally tapped out, and that we are going to see claims head higher despite what the market believes. And that contributed to a global market sell-off and prompted calls for the Federal Reserve to start lowering interest rates before its next scheduled policy meeting of September, something we knew they weren't going to do, and economists agree. Instead, several expect a 50 basis point cut next month as opposed to typical 25, although officials are likely to push back on a move because the market wants a rate cut here because they know it's bullish. So you see a big pullback. You get investors to kind of come in after the hedge funds and the banks, and everyone comes in and buys, and they want retail investors to jump in. And how do you convince them of that? Well, if the Fed cuts, it's bullish for stocks. But as history shows, when the Fed cuts, it means the economy is going down. And that's what two-year Treasury will follow. And so we need to be watchful of where the two-year goes, because if it continues to fall, it says the labor market is going to unwind in a big way. And if that also means continued claims would head higher, as we can now look at two-year Treasury yields shown in blue against continued unemployment claims. So while the market is celebrating perhaps that initial claims came down and that this signals that we are indeed at that bottom of the soft landing, well, look at what happens when two-year Treasury yields go down. It's not bullish for the economy like the stock market believes, because it means continued claims are going to head higher. You see that here in the dot-com bubble, again in the global financial crisis. You see it coming into the pandemic. And how about right now? Everybody's hoping this is the peak in unemployment claims, but two-year Treasury yields saying this is just the beginning, and things are going to get far, far worse. And the data bear watching for signals is about more material weakening in the labor market going forward, which would have implications for the Fed policy. And that is true because it's the bond market that tells the Fed there's a problem with the labor market. They signal modest economic slowing, not a contraction. Well, we're not there yet, but we are definitely in the early stages of it. And this report that came out yesterday validates it. As we see here from Zero Hedge, on the verge of a credit shock, credit card debt now posts the biggest drop since COVID crash as rates hit record high. And you have to keep in mind, we're in a debt-based economy. So that means consumers typically go out and buy things they don't need with money they don't have and pay on it sometime later. And that's why, of course, consumer credit is so important, because when consumers start charging things, well, it means the layoffs are only about to go up. And on a day when an early attempt by the BOJ to kickstart the global carry trade by capitulating on Japan's recent mistimed foray into rate hikes has crashed and burned with stocks tumbling, we see the Fed poured gasoline on the rising flames when it reported June consumer credit data that was atrocious and confirmed our worst fears. The consumer in the U.S. has hit a brick wall, and we've been warning this was coming. And while non-revolving credit saw a sizable increase, the real shock was in June here, because revolving credit unexpectedly tumbled by a whopping $1.7 billion. It's now the biggest drop since the COVID collapse. And more ominously, every time there's a sizable drop in this category, some economic calamity either follows or has already started. And that's what we're seeing in the stock market right now. It's starting to indicate that perhaps the bond market has got this right. But investors, again, they're conditioned. Buy the dip, and keep buying the dip. And now they're going to find out that perhaps we're in the early stages of a bear market. Did you get a sense of just how rare it is to get a negative credit card debt monthly change? Consider that in the 6 years prior to the COVID crash, the U.S. recorded just 5 months of negative print, and all intended to precede major drawdowns in the economy. We expect no less this time because, again, when consumers stop charging, well, that means businesses have less foot traffic. That means they sell less, lead fewer employees, less new orders. The factories clear out the backlogs, and then they clear out their employees. And yet, with consumers even more strapped for actual cash and equity, as the personal savings rate in the U.S. has now collapsed from 5% down to 3.4%, which is the lowest since 2022 in just a matter of months. To what we're seeing here, consumers draining down their savings. We're seeing the total compensation in terms of wage increases and hours worked continue to decline. And all this is signaling is at some point they hit the brick wall with the credit cards, and it could be here. And there's only so much more credit card maxing out that can take place before reality finally sets in, as this can be seen in the next and perhaps most striking chart yet. Total credit card debt is at an all-time high, while the personal savings rate is at a record low, and that is a dangerous sign because it means consumers are going to stop spending in a big way. But there's further evidence they're out of money, and that has everything to do with the delinquency rate. As we now look to the Discover Capital One net charge-off ratio and look at this, we're seeing them rising, and only credit shock left yet to drop is when consumers actually enter default. And right now you're seeing that happening and accelerating, which is validating everything we're seeing here is that the U.S. economy is not running on all cylinders. We're running out of money here. Investors are looking at the opposite, saying, look, there's just a huge opportunity to buy the dip. The problem is, without the leverage underneath it from the carry trade, you're not seeing the markets rally. What you're seeing is a market running out of money. And as far as the labor market goes, well, we know when spending rise up, as we look at advanced retail sales, shown in blue on a year-over-year rate of change, what happens is continued claims rise. And you see that happen almost every instant, and it's very simple because when a business can't sell, well, you don't need idle employees, and right now the market is hoping this is the peak in continued claims. But what we're seeing in 2-year treasury yields and what we're seeing in, of course, the credit card data and retail sales is suggesting now the worst is yet to come. And that means, of course, the stock market, which is trying to pull as much money in as possible, perhaps in the wrong side of the trade. But one place you can be on the right side of the trade, and that is with above food, because when you look for opportunities, you want to trade and buy when you're at the bottom of supply zone. Check them out on the NASDAQ under symbol ABVE. We'll look at some charts in a moment. Let's take a look at what's going on with above food, and remember, everything is in the pinned comment and description below. And they're a combination of strategic transactions that are expected to provide approximately $16.7 million of incremental capital to fund future growth and improve net leverage. Remember, they're an innovative food company, leveraging its vertically integrated supply chain to deliver differentiated ingredients and consumer products. They announced a business update. We're going to take a look at that. Now, at Above Food, we're not just another player in the food industry. We're breaking the boundaries and disrupting tradition. Above Food is revolutionizing the entire food chain with our unique seed-to-fork platform. This innovative approach integrates regenerative agricultural, value-added ingredients, manufacturing, and consumer products, which positions us to address the powerful secular better-for-you trends, global food security challenges, and supply chain fragility. We're excited to share our compelling story with the investment community and demonstrate our ability to drive momentum in our specialty ingredients business, generate improved margins, and leverage the utilization of our asset base to increase our revenues in the coming year. We've achieved a strong revenue CAGR of 34% from fiscal year 2021 to fiscal year 2024 by meeting a unique need in today's marketplace with our focused platform, and with continued growth and greater utilization, we expect to strengthen our cash flow generation in the years to come, setting up an early opportunity to invest in their stock, and particularly at a point where sitting in the bottom of supply zone. This is where you want to be buying, not at the top. You want to buy at the bottom. Again, check them out on the NASDAQ under symbol ABVE. And at the core of Above Food competitive advantage is its ownership and control of key supply chain entry points. The strategic positioning allows for superior economics, supported by advantageous margins and sustainable long-term growth drivers when operating at scale. The company's model addresses a vast market opportunity with a total addressable market exceeding $200 billion across plant-based substitute categories and related high-growth agencies such as pet food. The potential for growth is further bolstered by favorable macroeconomic tailwinds, including rising concerns over food insecurity and increasing supply chain risk globally. And they're positioned to scale with existing assets to become a leading and profitable operator in the industry as they service a diverse customer base of over 260 clients and boast a retail distribution footprint spanning over 62,000 points. The extensive reach is supported by owned production and efficient processing facilities, which in the disruptive agricultural segment alone are capable of producing $650 million in revenues, more than double the revenue generated in the fiscal years ending January 2023 and January 2024. A key differentiator for Above Foods is its ownership and control of proprietary seed genetics. The company is actively engaged in ongoing trade improvements through advanced agronomy, production protocols, and natural genetic selection. This focus on seed technology positions Above Food at the forefront of agricultural innovation and sustainable food production. And this is setting up an incredible opportunity as an investor. And you can see when you want to look for a trade and you're trading supply zones, you want to be buying at the bottom. So in this lower supply zone, you see those two purple lines, and then you want to look for a move into the upper supply zone. And you can see as the stock came down after its IPO, it traded down and formed a bottom into this lower supply zone and then rallied up 24%. And then it pulled back, getting ready for its next move here. And as we zoom in to this 15-day chart, you can see it very clearly. Buyers came in here at the bottom. It rallied up 24% into this supply zone, and now it's pulled back down, creating the opportunity for you right now before it makes its next move higher. And you can see the evidence of buyers are down here as we look at this volume profile line. That's that red line here. And I've drawn it across so you can see as buyers are coming in, which is consistent of what you want to see in a supply zone, is when price comes down where buyers want, they snap it up and then push it higher. And that is setting up an incredible opportunity in Above Food. Again, you can find them on the NASDAQ under symbol ABVE. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.